You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast.
Good to be here. And things are certainly interesting out there in the markets right now.
That's one way to put it. Yeah, markets seem to be really bracing for, well, maybe deeper volatility. They're reeling from what looks like a triple whammy.
Yeah, that's a good way to frame it. You've got that tech sector turmoil, then the surprisingly weak labor data that came out.
Right, very weak. And then just underpinning everything, those ongoing U.S.-China trade tensions just keep escalating.
It's painting a very clear risk-off picture, I think. The dollar index, for instance, it's really struggling below that key 100 mark.
And you see gold consolidating, right, near that $4,000 safe haven level being talked about. That signals something significant.
Definitely signals some real underlying fear about, well, what the Federal Reserve might do next, especially with that weak labor data.
Which is striking, isn't it? Challenger job cuts surging 175% in October. That's quite a jump.
It confirms the U.S. economy might be losing steam, maybe faster than people thought, and that really shifts the Fed outlook.
So today we're going to try and unpack these core drivers, connect the dots, if you will.
Exactly. Look at that labor data, the tech conflict, particularly the NVIDIA chip block to Beijing.
And also how new partnerships like that U.S.-Uzbekistan deal are kind of reshaping the global map.
And tying it all back to the geopolitics affecting commodities like oil, Russian exports, that new critical minerals list from the U.S.
Okay, let's unpack it.
Let's start with the domestic side then, because that labor market slowdown, the speed of it, feels like the most immediate shock here.
Yeah, that Challenger number, 175% surge in job cuts for October. That's not just noise, is it? It feels like a real signal from corporations.
Well, it's forward-looking, isn't it? It's not just, looking back at unemployment numbers. When companies announce cuts like that size.
They're bracing for something.
Exactly. They're preparing for a much slower period ahead, maybe anticipating a harder landing than the Fed has been projecting.
And the market reaction tells you that, too. The dollar index diving below 100 right after that news. So, if companies are signaling worry, how does that feed into the Fed's path?
Oh, it flips the script entirely, completely. Yeah. Before this, there was still that persistent higher for longer narrative for rates.
Right.
Now, the market's pricing in rate cuts. Maybe deeper, maybe sooner. The weaker the labor market looks, the faster the Fed might have to pivot.
So that dollar weakness is directly tied to the expectation that U.S. rates might come down relative to others.
Absolutely. The interest rate differential expectation is narrowing fast. That's driving the dollar down.
Which brings us back to gold. You mentioned it consolidating near $4,000. Now, obviously, it's not trading there, but that figure being discussed, is that just technical analysis or is it pure psychological hedging?
I'd lean towards the psychological, but it's rooted in real fear. That $4,000 number, it's becoming a sort of mental marker for extreme recession worries mixed with geopolitical hedging. So when you see money flow into gold, yen, treasuries all at once, people are hedging against two things. A bad recession, forcing the Fed to cut rates, maybe aggressively.
And the ongoing geopolitical instability.
Exactly. That specific $4,000 talk suggests some traders are even gaming out a scenario where, a deep recession leads to a very inflationary policy response. Hyperinflationary, even.
Wow. So the whole soft landing discussion has kind of evaporated. It's all risk mitigation now.
Seems that way for many.
And speaking of risk, let's pivot to that second big driver. The U.S.-China tech conflict escalation.
Yeah, this is where the strategic angle really comes into focus. The U.S. blocking NVIDIA from selling even those scaled-back AI chips to China.
These were the ones specifically designed to comply with earlier rules.
Yeah.
Right? Like the A800, H800 models.
Yeah.
Lower capability.
Precisely. They were already slower, less powerful than the top-tier chips. Blocking even those sends a very strong message.
What message is that?
That Washington seems to be moving towards a zero-tolerance stance on China catching up in AI. It suggests any enhancement, even a limited one, is seen as too much of a national security risk now.
Even NVIDIA's own CEO warned this could backfire, couldn't it? Pushing China towards faster domestic development.
That's the risk, yes. Forcing self-sufficiency could accelerate their progress in the long run. The stakes here are just immense for the future of AI dominance.
And this strategic move hits China when their own economy is already showing some weakness. We saw exports contract unexpectedly. Imports weren't great either.
If you connect the dots, it looks potentially timed, doesn't it? China's dealing with soft domestic demand, weaker trade. These sanctions add another layer of difficulty.
How so?
Well, it forces them into expensive domestic R&D efforts while simultaneously cutting off a key supply of advanced computing tools. It sort of compounds their growth challenges right now.
Interesting timing, too, with comments from President Trump about holding off on new tariffs while the Supreme Court looks at existing ones. It's like a pause on one front.
While the battle rages on the tech front. Yes, that tariff pause feels tactical, maybe political breathing room, but the real strategic fight is happening with these tech controls and resource partnerships.
Which brings us nicely to the third factor, geopolitics and this push for, let's call it strategic diversification.
Right. That big announcement, a $35 billion trade and investment deal with Uzbekistan, that feels very deliberate.
Uzbekistan, why is that partnership so significant?
Well, it's huge for Central Asia itself, but for the U.S., it's a clear step to build supply chains, secure resources outside of the current geopolitical hotspots and rivals.
What kind of resources?
The focus is broad energy, agriculture, infrastructure, but critically, it includes critical minerals. Uzbekistan has significant deposits of uranium, rare earths, things the U.S. increasingly wants secure access to.
That $35 billion investment looks like locking down a long-term resource partner in a really vital region.
Exactly, and that focus on critical minerals isn't just happening abroad. Closer to home, the U.S. Energy Department just updated its own list.
Right, adding uranium, copper, and silver. Why those three now?
It signals a real hardening of the stance on resource independence. Uranium, obvious nuclear energy and security implications. Copper, absolutely vital for the green transition, EVs, grids. And silver, crucial for high-tech manufacturing, solar panels.
So classifying them as critical means?
It means a commitment to boost domestic production, streamline the permitting process for mining, and actively reduce reliance on imports, especially from potentially adversarial nations.
And all this is happening while energy markets themselves are still quite volatile, despite the global slowdown fears. Brent's near $64, WTI around $60. That seems like a solid floor.
That floor is almost entirely the conflict premium, isn't it? The Ukrainian drone strike on the Volgograd refinery was a stark reminder.
That Russian supply disruption risk is still very real.
Very real. So even if global growth is slowing, the immediate risk of supply being knocked offline because of the conflict keeps prices supported. It's that constant tension. Macro slowdown versus physical supply risks.
Are there other geopolitical developments feeding into this general unease? We saw more activity in the Middle East, Israeli raids, reports about a potential new U.S. base near Damascus.
Those regional tensions definitely simmer in the background, adding to the overall risk perception. But, on the diplomatic side, there was that quiet inclusion of Kazakhstan into the Abraham Accords.
Ah, interesting. Expanding that framework.
Yeah, it seems part of a broader U.S. strategy to build regional stability and cooperation, extending those partnerships beyond just pure economics.
Meanwhile, the economic pressure on Russia just keeps going. Treasury Secretary Bessent was quite firm, wasn't he? Saying Russian-linked energy traders like Gunvor will stay blocked.
Absolutely firm. It signals this isn't temporary. It's a structural part of the financial landscape now. These long-term sanctions are designed to create persistent capital flight and financial pressure, contributing to that broader volatility in global commodities.
Okay, so let's tie this all back together for the listener. What's the market telling us with all this?
Well, it's a classic flight to safety, really. You've got dollar weakness driven by those shifting Fed expectations after the jobs data.
And gold strength, driven by that combination of recession fear and geopolitical unease.
Exactly. Tech stocks, meanwhile, are feeling the pressure from that escalating U.S.-China friction over semiconductors. The big theme is defensive positioning, hedging against a very uncertain outlook.
The market reaction seems, well, logical given the inputs. The jobs shock fuels the recession story.
The tech blockade hits future growth prospects, especially in semis.
And the geopolitical risks keep that conflict premium alive in commodities.
Right. So now traders are laser focused on what comes next, particularly things like U.S. inflation expectations. Does the slowdown in jobs start translating into cooler inflation? That's the key question.
The pressure really feels like it's shifting back onto the central banks now, doesn't it?
Yeah.
To justify their current stance given this new data.
I think the main takeaway is the market's mood shift. It's moved from maybe hope for a soft landing to hedge against something worse. That weak labor data wasn't just a number. It signaled corporations potentially losing faith in a quick recovery.
And that forces shifts in how capital gets allocated. very quickly.
It also shows how these big strategic decisions, blocking chips, making deals in Central Asia, aren't just abstract policy anymore. They have immediate, visible impacts on market sentiment, right alongside the traditional economic numbers.
The economic cycle and geopolitics are just completely intertwined now.
Absolutely. Can't really separate them.
So maybe a final thought to leave everyone with. If these job cuts really do signal that corporate America sees a hard recession coming, not just a soft patch, consider the AI race. Who gets there first? Is it China, pushed into maybe painful but ultimately successful self-sufficiency by these blocs? Or is it the U.S., having just cut off a major market for even its less advanced AI tech?
That's a crucial question. The answer could really shape the next decade for the tech sector, couldn't it? A fascinating dynamic to watch.
It certainly is. Well, appreciate you tuning in for this analysis of the triple threat facing markets.
Yes. Thanks for listening. Join us again next time on the Financial Source podcast for more market insights and context.